Okay, so you want to buy a home. Awesome. But home prices, they continue to rise year after year. And so the big question becomes, based on your salary, how much can you actually afford? Well, in today's video, we're going to break down exactly how much home you can afford based on different income levels, including a personal or a combined income of $50,000, $100,000, and $200,000. We're going to cover everything from how to qualify for a mortgage. We're going to talk about down payments, the impact of mortgage insurance, and a whole lot more. And at the end of this video, I'm also going to share a secret with you to having enough money left over to allow you to save for retirement and maintain a good quality of life without being completely house poor. But before we get started, if you're new to this channel, my name is Glen Hopkins, and I create videos all about Canadian real estate and my local market of Surrey and White Rock, BC. So if that's something you're interested in, please go ahead, subscribe to the channel now, and that way you won't miss out on any of my upcoming videos. Also, if you'd like my help with either buying or selling a home here in the Surrey or White Rock area, there is a link in the description box below where you can schedule a call with me at your convenience. And if you're anywhere else in Canada and you need a referral to a fantastic agent, don't worry, I've got you covered. I know amazing agents throughout the country, and I can gladly connect you with them. All right, so let's get into it. For the vast majority of people, the first step to buying a home is getting qualified for a mortgage. Now, that said, it's important that you understand what lenders look at before they just hand over wads of cash to you. The first thing that they're going to look at is referred to as what's called your debt to income ratio, which is something you can think of as kind of a balancing scale with your income on the one side and your debts and your potential mortgage payments on the other side. And there's also two main ratios that they're going to be very interested in. Now, the first one is what's called your gross debt service ratio. So I want you to picture your income as a piece of pie. Now, your GDS, or your gross debt service ratio, is a slice that goes towards your home costs, like your mortgage payments, your property taxes, your heating, and 50% of your condo fees. And the maximum slice of the pie that you can allocate is 39%. So if you earn $100,000 a year, your slice is going to be $39,000. The other is your total debt service ratio. Now, with this, they're going to add all of your other debts, like your car loans, your credit cards, to that piece of the pie. So your TDS ratio ensures that your total debt does not exceed 44% of your income. So if you have a $100,000 income, your total allowable debt is $44,000. Now, here's where it gets a little bit tricky, because in Canada, we have what's called a mortgage stress test. Now, this means that even if you qualify for a certain mortgage rate, the lender is going to test your ability to make payments at a higher rate. Now, typically, it's 2% above your actual rate or the Bank of Canada's 5-year benchmark rate, whichever is going to be higher. And this is to ensure that you can handle any kind of future interest rate hike. So for example, if your mortgage rate is 5%, you need to qualify as if it were 7%. So as you can imagine, this stress test can actually reduce the amount you can borrow, but it's actually designed to protect you from future financial stresses. And it's a crucial step, so you need to keep this in mind when you're calculating how much home you can afford. All right, so let's get down to the numbers. Now, in most cities throughout Canada, you can buy a condo or possibly even a townhouse for somewhere around the $500,000 range. So for the purpose of this first illustration, we're going to talk about the mortgage amount that you need to purchase a $500,000 home. And then a little later, I'm going to share how much of a mortgage you can qualify for and how much of a home you can afford based on various income levels, including a $50,000 income, a $100,000 income, and a $200,000 income. So let's go ahead and start with a mortgage amount that you're going to need to purchase a $500,000 home. Now, assuming a 5% down payment and an interest rate of 5% over a 25-year amortization period, you would need a gross income of approximately $113,000. And that income can be either yours alone or a combined income of you and your partner. So here's how it all breaks down. The home price is $500,000. The down payment is 5% or $25,000. and your mortgage amount is going to be $475,000. Now, this calculation includes factoring in property taxes, condo fees, and heating costs. So if you and your partner together earn around $113,000 annually, you could potentially qualify for a $475,000 mortgage. Now, just note, of course, that this is a ballpark figure and individual circumstances, they can vary, but this is going to give you a very good starting point. And by the way, if you're getting any value from this video whatsoever, please do me a favor, go ahead, hit that like button. It just takes a second, but it helps me get the word out to other people just like you looking for this kind of information. Go ahead, do it now. It just takes a second. All right, so it's also important to note that if you're putting down less than 20%, you're going to need to factor in mortgage insurance. Now, this insurance is added to your mortgage amount and it protects the lender in case you default on your loan. So what does it cost? Well, for a $475,000 mortgage with a 5% down payment, your mortgage insurance could add around $19,000 to your loan amount. This means your total mortgage would be approximately $494,000 and your income requirement would be slightly higher. But what if you could put down 20%? Well, if you could put down 20% or more, you wouldn't need to pay for mortgage insurance, which is a big plus. However, doing so does not significantly lower your income requirement. So for a $500,000 home with a 20% down payment and a 30-year amortization, you would still need a gross income of about $98,000. And so the difference is going to be minimal. And that's because your interest rate might be slightly higher over a 30-year amortization period, which is balancing out the benefit of no mortgage insurance. Now, in just a second, I'm going to share with you the number one most important thing about qualifying for a mortgage that you absolutely must know. But before I do that, I want you to remember that the maximum GDS ratio might go up to 44% if you have excellent credit and strong financials. And if it does, this could mean qualifying with an income as low as $88,000, depending on the lender and your specific situation. So at this point, you might be asking yourself, what can you do if you can't meet these income requirements? Well, don't worry, you do have a few options. The first and probably most obvious is to consider looking at lower priced properties. Or you can increase your down payment through increased savings or gifts, or you might also be able to get a co-signer to boost your qualification chances. And then finally, another strategy is to improve your debt income ratio by paying down existing debts before applying for a mortgage. Okay, so as mentioned earlier, let's have a look at how much of a mortgage and therefore how much of a home you can afford based on different income levels. With a $50,000 income, you should be able to afford a mortgage of up to $200,000 if you have a 20% down payment, which means you can buy a home worth around $250,000. With a $100,000 income, you should be able to afford a mortgage of around $400,000 with a 20% down payment, and this means you could buy a home worth around $500,000. And with a $200,000 income or combined income, you should be able to afford a mortgage of up to $800,000 with a 20% down payment. Now, this is going to mean you could afford a home worth about $1 million. Now, of course, your personal income more than likely is not going to be exactly $50,000, $100,000, or $200,000. In fact, it might be wildly different. So here's a straightforward method to estimate how much mortgage you can afford. Now, typically, you can afford a mortgage that is 4 to 5 times your gross annual income. So if you earn $100,000 annually, you can afford a mortgage of approximately $400,000 to $500,000. Now, this is going to be a good ballpark figure to use when planning for your home purchase. And a tip that I always share with my clients is this, if you're approved for a maximum gross debt service ratio of 39%, I want you to consider buying a home that only uses up 25% of your gross income. And I say this because this way you can save 10% of your gross income for retirement and still live comfortably without stretching your finances too thin. So for example, if your household income is $100,000 aim for a monthly mortgage payment of around $2,083. And this would allow you to save for that retirement and maintain a good quality of life without being completely house poor. Just remember that buying a house is a significant financial decision, and it's crucial that you plan accordingly. So I want you to consider all of the factors, including your down payment, your closing costs, and your monthly expenses. And of course, working with both a realtor and a mortgage broker can provide personalized advice, tailored advice for your specific situation. And if you do need a referral to a mortgage broker, just let me know and I'm happy to share that with you. In the meantime, affordability calculators are a great tool, and you can find calculators on various websites, including realtor.ca. And just simply input your income, your debts, and estimated housing costs to give you an idea of how much you can afford. And this is a quick way to get a ballpark figure prior to working with a mortgage broker. However, just know that when you do speak with a lender, they're going to look at your debt service ratio, your down payment, your credit score, and more. They're going to look at all these to determine how much you can afford and if you qualify for a mortgage. Now, traditional lenders are typically going to be your bank or a credit union where you already have some sort of a relationship. Mortgage brokers, on the other hand, they work with multiple lenders and they can shop around for the best rates and terms on your behalf. They can also find better deals because, well, they have access to a broader range of options. Again, just let me know if you need a referral to a recommended mortgage broker, and I can share that with you. Also, be sure to keep in mind that your credit score is going to play a significant role in determining how much home you can actually afford. And that said, I want you to check out the other videos that I created on how to boost your credit score and qualify for the mortgage that you want and need. And there's so much more to know about buying a home, including finding the right neighborhood, knowing the types of houses that you must avoid buying, understanding your closing costs, and so much more. So make sure you go ahead, watch some of the other videos popping up right now so that you can make the right home buying decisions. And remember to go ahead, leave a comment below, share your thoughts, share your experiences. And if you have any questions, please feel free to leave them below. I'm always happy to help wherever I can. Otherwise, I will see you in the next video.